So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to grow your wealth. I'm your host, Brett Swarts. In each episode, I am joined by some of the best real estate, financial, and wealth minds in the world, where they share their ideas, deal stories, and inspiration, so together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He is the founder of Griffin Living. And he founded it in 2009 and has since overseen all aspects of its growth, from a regional developer in California to our award-winning, nationally recognized firm with properties across the United States. He is what I call a commercial real estate Hall of Famer with lots of knowledge and wisdom to share with us, and it goes multi-generational, which is going to be really fun to dig into. But he has oversaw and developed a wide variety of projects, including award-winning senior living residences, multifamily residential homes, apartment complexes, retail centers, and commercial office space. In fact, he has developed over $4.5 billion in assets over the course of his career, and he has been honored with numerous awards, including the Habitat for Humanity's Builder of the Year in 2000 and the Building Industries Association Builder of the Year in 1997. And he's been recognized by the National Association of Home Builders and the Pacific Coast Builders Conference for excellence in design and community land planning, and so much more. Please welcome to the show, Paul Griffin. Hey, Paul, how you doing?
Good. Thank you for having me. It's just lovely to be here.
Absolutely.
It's funny, you're talking about our awards, and around my management team, we have a wall full of awards right over there. But among my management team, it's nice to be recognized. So I can see all of those. We just have a ton of them. The kind of things, we put up in our conference room, but our feeling around it generally is, gosh, you win a big award. Does that mean the project actually made money or not? Getting to the bottom line. So we appreciate being recognized. It says something that in terms of what our colleagues think about us, but it doesn't actually drive the business. We hope. We don't want to get focused on the wrong things.
Absolutely. Stick to the fundamentals. And with that, would you give our listeners a little bit more about your story and your current focus?
I am the fifth generation of my family to be in a real estate development here in California. We started in 1903, and we've developed as a family through the generations in different entities. We've developed something in the neighborhood of $12 billion worth of real estate, and something in the neighborhood of, we've got on the walls here and over there aerial photographs and outline where all of our projects are. Have been through the years, and something in the neighborhood of 40,000 houses. So a fairly good size. I started working after graduate school in 1980, and worked for my dad's firm. He had McKinsey company were their consultants. Their big dad's company was doing about $350 million in sales per year. So it was a pretty good sized company. And McKinsey was, big, no nonsense consulting firm. I learned a lot from their senior managers. I came in as a kid, just learning underneath it all. Happy to be a fly on the wall in most of those meetings. His board of directors was a chairman of TRW, the founding member of one of the largest tax accounting firms in the country, a founding member of one of the largest law firms, Cox Castle Cook, another senior partner, Price Waterhouse, people of that ilk. And I loved working and learning from them. And the business came up. I Made a deal with my dad to buy him out of his company in 1992. I paid him off his equity that he loaned me to buy his company by 1996, and I paid him all of his profit share by 2000. So been managing it. Have nieces and nephews that are coming up behind me and looking to push me out of the way, and I love it. They're pretty serious, as we were there at Harvard and Stanford and Oxford, MIT, University of Chicago, bright kids. And, I love it. They're all out working at different companies now, getting experience, different points of view than I would have. And they are welcome to come and knock me out of the saddle. So the Griffins are happy. The future, looks good is real estate in California. We are branching out now to we've been developing in the Atlanta market. We're up in Connecticut and trying to push into Brooklyn and Queens. We've got a couple of projects working on and down in Boca Raton, Florida. So we're trying to branch out more also other parts of the country. We're excited about the prospects.
I love all of that. And I love the friendly family competition, and I love that all of the kids and the nephews and such are out there in the world, and in a vast variety of educational, higher education, and then different careers. So that and then the thought of, hey, I want to come back to the business and keep the family legacy going, which is just beautiful. I love that. I love the 1903 beginnings. $12 billion in their asset value. It's just, it's a beautiful American dream story, family story. So that being said, I want to take one step back. So I'm curious, before your time of running the company, right, and even when you maybe your college days or high school days, I'm curious. I believe we've all been given certain gifts in this life, and I believe they're God-given gifts. They're given to us to be able to be a blessing for others. So I'm curious, when was that gift? Maybe some people might call it a superpower, but what's that one or two gifts that you believe you were given, Paul, and how does that help how you bless and help people today?
Right, no one ever asked that question. That is a great question. I think the most central gift in my life is I have a heart for the people around me. I actually like them. I come to work. The people that I work with, I really treasure through the years. Our contractors, our consultants, have been such friends. And our customers, I've always really had a passion about, well, what does it, the person that either rents space from us, whether it's one of our shopping center tenants or a restaurant tenant, or if it's a family that's renting an apartment, could be a family that's purchased a home from us. What do they think? Sorry, what do they think? And how are we treating them? Is this a happy experience? Are we really meeting their needs? Could we do better? And I think that having that passion drives really all that I do. Somewhere mixed in that is just an entrepreneurial spirit. I don't know if that runs in the Griffins, and that's why we've been in business all these years. The very first Griffin came to America as an indentured servant in 1634. His name was William. So he's in debtor's prison for some reason or another. He just dropped off at Virginia. He escapes his master and runs up to hide out in the Dutch colony at New Amsterdam. And the first real estate deal we have is William doing a real estate deal. We've got what effectively is the grant deed from the 1630s from William doing a real estate deal. So I don't know, it just seems to run genetically. I did my first project while I was in college. I was an undergrad at UCLA, and I could either work, if my dad did not like it if we weren't working all the time. So I could either, continue to work for my father on projects, what have you. And I just had the bug. I tied up an olive orchard here in the Los Angeles submarket, about 60 acres, and subdivided it into 64 single-family lots. Used the increase in the value by the subdivision to go over and get a loan from Bank of America. They used to make loans with much better ratios back then, about 80% loan to value. And you could get up to 85% if I paid him a kicker. So effectively, the entire cost, including paying for the land. So the family down in Newport Beach that owned the Olive Grove, I did all the engineering and the work on songs and prayers with my consultants, my engineers and architects and everybody, and paid the family off, paid all the consultants off, and moved forward into construction with the construction loan. Built my first project as I finished college and was going into graduate school, and that just really enjoyed being in business, that entrepreneurial spirit. So I don't know, somehow being an entrepreneur, and I'm not as passionate about how much money we're making. I'm much more passionate about what did we create? Was it good? Is the customer served? How do our consultants and our contractors, how does everybody feel about the process? Are they happy? What do they have to say to us? And that gets me out of bed in the morning. I really enjoy coming and working every day.
That's beautiful. I love the servant's heart first and caring deeply for each individual that's involved with the company and the projects and the actual tenants that you're serving. That really shows through. I appreciate you sharing that. When did you kind of become fascinated with investment real estate, in particular senior housing? Because I know you guys have a history of multifamily as well as retail, grocery centers, and then of course land development, and all those homes. But let's kind of narrow focus, because I think that's such a need right now when it comes to just the aging population and the lack of care and facilities and housing. So give us that a focus for a minute here.
Right, that really came about after the 2008 recession, which was just a disaster for everybody. There was no capital to go beg, borrow, or steal. I found capital at Import-Export Bank of China, and Chinese money was all there was around, and they're very difficult to do. Great people. I like the individuals I was dealing with. Really tough institutionally to deal with. But I got a major line of credit from them. We got a major line of credit for them, and we started. They've got a demographic problem in China that's just overwhelming due to their one-child policy, and families just haven't had more children, so their birth over death ratio to young people is not a wide bottom pyramid. It's kind of upside down. We actually are facing that problem here in the United States, a little less pronounced than it is in China, but they really wanted us to use their lines of credit to see about senior housing for income. And we said, well, certainly we can do that. Started into 55 plus apartment rental models, and we got into a lot of the activities we always develop with a little bit more flair. It's our passion. So the outdoor areas were spas and cabanas and pools. The indoor areas, big, activity rooms, state-of-the-art spas and exercise and all of that, and lots of activities. So that was really received well by the 55 plus rental market. And I remember, so it was about 2011 as we were filling up our first project. It was a 204 unit project. And I remember our marketing manager had a speed dating for seniors. Well, that sounds, management here, but that sounds kind of clever. It backed traffic up all the way out to the major boulevard beyond the site. The police had to come and, cordon it off, and the evening news got excited about it and came out. So we got a whole bunch of publicity, and it was just a lot of fun. But we also started to realize the senior market is vital. Now, 55 plus and active adult, they're a little bit younger. So you're talking about people in their 70s, many of them still working, some of them going into partial retirement, but they wanted a lifestyle. They were a lot of fun to work with and get to know those families. And, I really, really started enjoying it. And from there, I started traveling around myself to say, well, I wonder where the future of this is, and going into assisted living buildings, independent living buildings, memory care buildings. And I was struck. Some of them are really beautiful, and I would move into, tomorrow I could move in, and interesting people to have dinner with. But a lot of them are really just dormitories and getting old and tired. The investors were leaving them as cash cows and letting the depreciation runs out, and not putting more investment in. So it got to be, some of them were pretty dreary and dismal in terms of a place to live. And as I looked at that, I said, gosh, we can do so much better than this. And it isn't really more money. The new development costs more in terms of construction, but they always do anyway. The management is not significantly more expensive, but you do have to put a different focus on. My thought going into it is we're going into it as investment because we like the income. We like the income model, the investment of owning buildings that are have assisted living components, independent living components, 55 plus active adult components, and memory care components. So from the investment side, it's really owning the income property. Then it's where we want to be in coastal infill, somewhere where the constituents and neighbors really don't want development, and we can shoehorn our way in. It creates value. It also creates long-term value for the asset as we manage it. So from the perspective of, as an investor, as a developer, there's one analysis that we do, and it's it really is about supply and demand and being where other people can't be. From the perspective of my customer and what I get excited about, I talking to my management team, really just let's don't ever have a property where if we walk in, we see a line of our residents in their wheelchairs and their walkers, really longingly looking out the front door, waiting for someone to come and pick them up. That's a sad, tired way to be, and we can do better than that. Again, it's not particularly part of the investment analysis, but it really is part of how we want to run a business, who we want to be, So when we walk in the door, the better centers will walk in and there's activities, there's people doing all kinds of things all around those centers. And the healthcare is got to be excellent. That's a given. But the dining services, we don't want dormitory dining services. We want animated evenings, food, menus. You can go in any time of the day and order, treat people like they've moved into one of these communities, but this is a wonderful place to live. And you have steak night. I want to really see the chef outside with a big barbecue. I want to see smoke coming all around and everybody thinking it's barbecue night. On a Sunday brunch, I want to see the carving stations, the omelets, all of that. I want families to come and see them. And I want Sunday brunch to be Sunday brunch. If it's Taco Tuesdays, we have those at my house. We want to have Taco Tuesdays. I want to, the fiesta night. I want everybody to be excited. Just the animation and food services.
I love it. I love it. I can't help but think about, Paul, the Walt Disney, not too far from where you're at in Calabasas, right? And what the vision he had for creating something more than just an amusement park, right? And I think that's what every good leader's doing for whatever they're serving. They're trying to make an experience in a product that is beyond just what you pay for, right? It's transformational. It's not just transactional, right? It's not just cash flow. We're going to take that cash flow and we're going to improve the property. We're going to improve our management. We're going to improve our systems, our services, and inevitably it's going to create more cash flow because you're going to be able to charge more and people are going to be glad to pay it because they're getting value for what they are paying. So what's been the single best way for you with that thought in mind to win new deals? Because let's face it, inventory can be challenging to find, especially for good opportunities and good places. And I can't imagine that. I imagine because of your family and your history and your ability and your track record in treating folks the way they want to be treated, they're probably going to bring you more deals. So walk us through how you're finding deals.
Brett, are you saying that deal I did when I was in college was really the family in Newport Beach that tied up their Olive Grove or B of A that made me the loan was really not because of my charm and wit, right? But because my dad had this monster family company behind me that said, oh, well, if the kid screws up, we're still here.
That's a good point, right? It wasn't your SAT scores, right? It wasn't your SAT scores in your grades for sure.
They really weren't loaning to my, yes, exactly. Well, Brett, our business, in real estate development, always, we go in like any other real estate developer. We're looking for property every day. We've got a forward planning group here. They're excellent. They're triaging projects and opportunities all the time. Some of them that we have high hopes for, we bring in and we talk about, and they don't go anywhere, either due to the land seller, won't finally come to terms, or we get into the city, the city fathers, the public bodies, or the neighborhood constituents if we can't get the job done. Sometimes it's an engineering problem. I had one tied up here in Calabasas that, it's a property that is needed development. Calabasas, very wealthy area, an aging population, perfect for, senior housing project. There was a deep landslide underneath the ground. You can't see. We went in and studied it, and I said, well, this is an engineering problem. We can solve that. $100,000 later in design and analysis, we can't solve it. It can't be done. But there's another up in the city of Thousand Oaks, a subsection, Westlake Village, where we have a project that's currently under construction and is pre-sales doing really well. Excellent property. Did get attention at NHB, National Home Builder Group, as a gold medalist for a project that's being designed and coming out. So beautiful site. At Thousand Oaks, we were looking at a different property, and the city council, city managers, told us flat, look, Griffin, you've developed thousands of houses here in Thousand Oaks since even before we were city. You're great, we love you, but no way, no how. We're not doing senior housing in Thousand Oaks. We don't feel we think it's a burden, not a help, and don't come here with those kind of proposals. To put an emphasis on.
Keep going.
Just to put an emphasis on it, two other really excellent senior housing developers came in with proposals all the way through city council before us, both turned down. I mean, the city of Thousand Oaks said, we are not kidding. Do not bring that stuff in. The mayor, we've known for a long time, and talked to him and convinced him that, really put us in a section of your city where, we're not in your way. We'll figure out the land, but you're really not, we're not bringing people from other cities to live in Thousand Oaks. We are really talking about residents of Thousand Oaks who have bought homes and apartments from us years and years ago, and now they really need senior housing. The city of Thousand Oaks owes it to its population to see to, this need that you have. And I guess we caught him, because later on he said, well, we've talked, among ourselves, and okay, you can come in and propose one project, just one. And if you get the neighbors around the project, upset, the answer is no. So we found a property and brought it in through the city manager and dealt with the neighbors around it. We got 100% support from the neighbors and the city council. So one project is going into Thousand Oaks. Of course, they need more. They will need more in the future. But anyway, this one's going in, and we're happy to have it. We got the neighbors, just how real estate development is. We got the neighbors supportive of that property because they had a traffic problem. And so we designed a traffic circle. They couldn't get the traffic department to put a signal in or a stop sign in. And they had a neighborhood school inside their community and a lot of traffic in the mornings and the afternoons, and stopped everything up with traffic that were using the arterials to get through to their offices and what have you. The traffic circle is a good solution. It slows everybody down. It allows traffic to flow through. You can come in and out of the neighborhoods. So we like to say that that's a traffic circle that we got approved by the neighbors and by the city of Thousand Oaks. And one of the conditions is we can throw a senior housing project in with it.
There it is. It's a people business, right? You got to find out a way
to solve problems.
Yeah, solve problems in people business. Love that. So thank you for sharing that. So now let's shift a little bit into capital gains tax, right? So in your history and all the deals you've done, what's kind of been the biggest frustration or challenge that you've found when it comes to capital gains tax deferral?
Well, for one, that we're always reacting to the laws as they change. And the way it's been for quite a while now is we have ordinary losses in our business, just as we manage it, because our business really at the core is we're developing, assets and then holding. We sell some of the assets, hopefully for a profit, but we try to hold assets if we can, put them out of the development company and into holding companies or companies that are owned by family members and keep them for long-term assets, and the management team who have you. It is not a smooth transition from our tax losses that we would have against ordinary income in our business. We have to have those losses sit on the side, and I can use those losses when we take a depreciated asset, income asset, and sell it or in some way move it and recognize gain, and which would generate a tax bill, and I can shelter the tax bill at that point against our operating losses. So it means I've got operating losses through the years that are substantial, last tax loss carry forwards, if you will, that are substantial, and we can't get them. And what's going to happen is the last generation of parents and aunts and uncles will pass before us, and they won't have used all of their tax loss carry forwards. We won't have been able to use them in the assets that they are involved in. And without just selling all of those assets, and that the math is better for us to sell some of them and keep some of them even from that generation. I see that same problem coming in my generation, my brothers and sisters and everybody. We won't likely be able to use all of the tax loss carry forwards in the income properties that we have. This depends on how long we live. Maybe we all live a long time and can figure that out, but it's not that smooth. The other problem, Brett, if I'm being clear, I think all of your listeners already know what we're doing is in a permanent asset. We hold it at its basis. We depreciate the value from its basis until we run out of depreciation that we can use. And we use the depreciation against ordinary income as we depreciate, which is something I'm sure all of your listeners are well aware of. Then we take the asset, and either we have to reinvest in that asset to restrike or reset some depreciation, or we have to sell the asset and purchase another one that maybe we can put some money in and create value, add kind of a situation and restart the depreciation clock.
So on that point, are you doing 1031s when you're doing that, or walk us through?
We certainly have done that. Sometimes we sell, use tax losses for the gains, and still just purchase other assets with the actual cash coming out. 1031's nice, but we also don't want to get tied up and not make the right decision on which value add asset we're going to purchase.
Yeah, I call that the forced marriage. I call that the 45-day engagement and the shotgun wedding.
And we've done you name 10 sites, and we've done all of that. Sometimes they work out, and sometimes we end up paying.
And to that point, though, I was bringing it up because the depreciation schedule travels, right? So if you fully depreciate and you do a 1031, guess what? It's the old depreciation schedule, right? So it doesn't necessarily get you out of that. So the intent is to get...
but what you're after, either way, whether I'm putting cash back into a property that we've depreciated and saying, well, we're gonna add more value to it. So if you think about it, the asset that you're talking about that maybe is depreciated, if we put more money into it, which actually I've got a shopping center right now, a shopping center. We moved the long-term grocer out, move Aldi markets in. They're, better state of the art for the community. CVS, a whole bunch of, small restaurants, shoe stores, eye doctors, all of that kind of thing. We looked at that asset, and so we still like the location. We like Aldi as a new key tenant. The whole thing's ready. It's 40 years old. We're ready to remodel it. So we put money in for the remodel, which of course we can depreciate that new money. But the other thing so for tax purposes, it's the money that we put in plus whatever was left in the shopping center. In terms of the value, the reason to do it is because our analysis is by putting that money into that shopping center, we create more value than just the original shopping center or the cash that we put in. We reposition the entire asset to a better use where it is. So we have a larger market value than otherwise.
Makes sense.
And taxes.
Yeah, makes sense. And so the The other thing I was curious on is the estate tax. We work with some ultra high net worth families and individuals. So what's been your best strategy as it pertains to because the stepped up basis does not account for the estate tax, right? It's separate from the capital gains tax, and so
yeah, I was in the middle of closing out my deals at with Import Export Bank of China, and there was a estate tax. I forgot how much it was at the time. I think it was 10 million or something. I can't exactly remember, but there was a number you could transfer over that year. So I had to go to Beijing and talk to them and, look, guys, we're going to, the borrowing entities and the guaranteeing entities and all that, we're going to, they're going to shift around for state tax purposes, because in America, we can shift from one generation to another of this amount of money, but it has to be this year. I'm so sorry. I should have the
no, but I mean, but the biggest thing is the challenge. I think there was another story like that. I think it was either the Red Sox or the Yankees or somebody, and I think it was the Yankees maybe. He I think it was Steinbrenner. I don't know. I don't want to get the names wrong, but he died in the year where there was no estate tax. It was the one year that was kind of a gap between the legislation, and his estate was tax free, right? But the next year, someone else, died who was an owner of this, family.
Don't you go giving my nieces and nephews any ideas. They'll just pick that year and nail me.
Seriously, right? So, but the point is, what are the strategies? We have with the Deferred Sales Trust the ability to sell in one single day, move it all outside the taxable state, any given asset as you sell, versus a lot of folks that before they meet us, they do family limited partnerships, they do gifting, but they can't get it out fast enough, right? It's only so much per year and so much you can do. And so they come to us and they're like, we're worth 125 million and we've gotten 25 out, but the rest of it's still in there and we still own all these assets and they're fully depreciated and we don't want a 1031 and so what have you been the best strategy that you've used to get it outside the taxable estate? Because let's face it, 40% on anything above right now, 22 million married, 11 million single, is we need to be hit with a 40% death tax upon 6 months upon the passing of the estate. And it's set in 2025 to drop back down probably to 12 million married and about 6 million single. So what's been the biggest strategy you've used to try to legally move it outside the taxable estate?
A couple of different approaches we had, and obviously this goes through tax accountants and attorneys that are good at this law. There's a
brain surgeons.
I just can't say enough. Make sure you get excellent advice, because it is there are technicalities that are particular. So absolutely, from a layman's viewpoint, which is when you're getting into accounting and tax law for estates, I'm a layman. An interested layman, bit of a layman. We've used a couple of procedures about it. One, to transfer some of the assets into families' trusts that used the tax laws at the time to slowly transfer at a basis that we started with it to transfer each year more and more of the asset from one generation to another. Then there still would be when that asset when the transfer is completed, if the recipients together say, well, let's go sell that asset, we'd like to cash out or do something else with the money. Of course, the markup from the basis that we transferred at, we did miss paying the estate tax, but we still have to pay the ordinary income tax on the increase in the basis. So, the issue is, and
it's kind of a rock and a hard place, right? You can either have one or the other, but you can't have both. And
exactly.
That's where, how do you do that? And by the way, we're running out of time, and we find another time to go through this even more detail. And it's kind of like part one. Maybe we'll have part two with Paul on here. But the answer is the deferred sales trust. You can actually do both, but you can't get the stepped up basis upon death, but you can maintain the tax deferral and your kids can keep going. And for our listeners who want to learn more about that, you can go to capitalgainstaxsolutions.com. But Paul, for those who want to get in touch with you, and we're running out of time, what's the best place for them to find you?
media@griffinliving.com. And you can also look up, always on our website, griffinliving.com, I guess.
Beautiful.
If you did our website.
Well, Paul, I want to thank
And
you for
we
being on
will
the
answer.
show.
If somebody has questions or thoughts, we want to know. If you got a better idea than I do, I want to know. Please do reach out to us. We will respond.
Excellent. And thanks everyone for listening to another show. As always, and Paul, thank you first of all for sharing your time, your energy, your part of your story, and your wisdom with us. It's been an inspiration. I want to encourage you to keep using the gifts you've been given to help people create and preserve more wealth and create housing especially for seniors, right? For folks who need it the most, and an amazing experience. I personally invest in senior living, assisted living facilities, multifamily, and mobile home parks is my next one I'm focused on. And so it means a lot. My mom actually was in she was an LVN nurse in a assisted living facilities in senior housing growing up. So when I was young, after junior high, I would go in and I'd talk with the folks and be with her as she's ending her shift. And so I have a heart for that part of it because it's kind of been a part when I grew up. So anyways, all that being said, thank you for being on the show. Reach out to Paul, connect with him, and anyone, if we can help you out, go to capitalgainstaxsolutions.com. We appreciate everyone for listening to the show. Take care, everybody. Bye now.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.